Well, our fund once again outperformed its peer group as well as its composite benchmark during the quarter. We delivered a return of 2.1% versus the peer group return of 1.7% and the composite benchmark return of 2%, all in US dollars. Over the past 12 months, however, with the anniversary of this COVID-related sell-off last year, while we managed once again to outperform peers, we underperformed the composite benchmark. The fund delivered a return of 29.8%, peers just over 25%, while the composite delivered a return of a little over 35% in US dollars. While the fund's underlying equity component continues to outperform the MSCI World, we delivered a return of 55% over 12 months versus 54% for the benchmark. The underperformance really stemmed from the heightened cash holdings within the fund as well as our short duration bond position. Extreme bond valuations, which we had warned about, revealed themselves in the quarter, with the Bloomberg Barclays bond index declining 4.4% during the quarter as heightened inflation expectations led to a rise in bond yields. By way of an example, the yield on the US 10-year Treasury, which was at 90 basis points or so in early January, rose to in excess of 1.7% late in March, while investment-grade credit and emerging market bonds also sold off quite meaningfully. Global equities enjoyed another strong quarter led by US small caps, with the Russell 2000 rallying 12.7% in the quarter, while value stocks continued their outperformance of growth stocks, which had begun in early November last year. The MSCI Value Index gained 9.7%, led by energy and financial stocks, and the fund, while we had no energy exposure, was reasonably well exposed to financials, with Goldman Sachs and Blackstone contributing meaningfully to fund performance, as well as Google. On the downside, the detractors included the likes of Unilever and Roche, some of the more durable holdings in the portfolio, as well as Amazon. Sell-off in bonds during the quarter afforded us the opportunity to rebalance some of the fund's bond holdings, and while we remain meaningfully underweight, we did take some profit in inflation-linked bonds. We've introduced some longer-dated US Treasuries, although the principal positioning within the fund remains in short-duration investment-grade credit with an average maturity of 2.5 years and a yield of 74 basis points, which we really consider as enhanced cash. We remain overweight equities, although it's fair to say that this can only really be justified on the basis of relative as opposed to absolute valuations, with the weighted intrinsic value discount of the fund's underlying equity holdings having narrowed quite considerably over the course of the last couple of months as equity markets have moved higher. In terms of the outlook, we think the balance of this year is likely to be very dependent on further positive developments on the vaccine front, as well as continued strong economic and earnings growth news flow, as well as accommodative stance from monetary policy authorities. And therefore, we remain relatively conservatively positioned and continue to diversify the fund's holdings.